I'd like to start, with your thoughts on perhaps the most technically and fundamentally bullish precious metal at the moment. That is palladium. It looks like it's, hitting new nominal price highs virtually every day, and it's only a few dollars away from the current gold price. Could you, perhaps to begin, just because some of our listeners may not understand palladium nor its supply-demand fundamentals, could you give us just a brief overview of what those are, and then we'll maybe move on to why the palladium price has been so bullish of late?
Sure. The palladium market is a really interesting market from my standpoint. It's a microcosm of what's wrong with the metals markets, in particular the London market, which is supposed to be on the LBMA is supposed to be a physical market. So what we're seeing today, James, is really a replay. We've seen this once before. We saw it in 2000. The price spiked to $1,180 per ounce in 2000, up from $100 an ounce in 1996. So it was, almost 12-time run there. And at the time, there was a real panic in London. The 6-month lease rate had shot to 300%. Dresdner Bank was begging the U.S. To release palladium from its strategic metals stockpile because they were at risk of going under. And it's interesting, just kind of an aside here is, the banks are so used to being bailed out that they do a bad trade, or they issue unbacked paper contracts for metal, and then they get into trouble and they demand, it's a German bank demands the Americans to release metal to bail them out. So these guys are continually, seeking gambling insurance whenever they get into trouble, right? So, and what happened then was that the Russians stepped in with their stockpiles. They had, in round numbers, about 25 million ounces at the time, and essentially saved the London paper market. But the problem that they had in London then, and that they still have today, is the fact that they're trading these unallocated paper contracts for metal. And if people need metal and all you have is contracts, then you've got a serious problem. Mm-hmm. And essentially, as long as the metal is flowing, you can set the price anywhere you want. When people are looking to you as the world's primary palladium market, which London is, when you run into trouble is when the metal starts to flow or stops flowing or has disruptions in the flow. At that point, you can offer as many of these unallocated paper contracts as you want, but it does not work. The users of the metal want the metal, mm-hmm. and in this case, it's auto manufacturers. Around 80% of the market is catalytic converter applications, and they're the ones who are really scrambling for this metal now. So. Right.
When you say catalytic converter, basically it's just palladium's added to the engines to basically stop pollution, to stop greenhouse gases, I suppose.
Yeah, it's a device that's put in the exhaust system. Mm-hmm. It's the first unit out of the engine in the exhaust train, mm-hmm. and the exhaust gases go through there, and they address nitrous oxide, which causes smog, and they also address the carbon monoxide issue, which is a poison for incomplete combustion. So they're very important devices, and you can't ship automobiles without these pollution control devices on them.
Right.
So do you want to take a look now at the size of the market? Because I've just got some rough figures here just to scope it out.
Yeah, that would help.
Okay, so in size, it's a small market. The annual consumption is of the order of 10 million ounces a year. That's according to Reuters. They gave it a 10.2 million ounce market size. And the deficit is estimated this year at about 1.3 million ounces. So you take your mine supply, you add into that your recycling supply, and then the remainder between what you've got there in terms of your available metal and your consumption is your deficit, and that has to be met from stockpiles. And this year, it's of the order of about 1.3 million ounces, according to Reuters GFMS. So we have a roughly a little over 10% deficit in the market. And Russia also is about 2.7 million ounces of mine supply a year. So when you add those two numbers together, you've got about 4 million ounces in terms of questionable availability. Around 40% of the market is in play.
Right, and then South Africa as well is a major producer of palladium. I think they're on the order of something like 35% of the market supply.
That's right.
So South Africa obviously isn't the calmest of places at the moment. So my hunch is there's not going to be some huge spring of production coming out of there.
No, and the palladium that South Africa produces is a byproduct of platinum production. So, and as you know, there's a over $300 spread right now between the palladium and platinum prices. The platinum prices are falling.
Right.
So and the other thing too that we've seen is looking at historic data. James, I look back to the UN export figures from Russia, and their raw, unwrought or unworked palladium exports. It's interesting. Between 2013 and 2015, they exported less than 50% of their mine supply. So you're looking at 3.5 to 4 million ounces that were not made available to the market from their mine supply at the time. And the other thing I found very interesting was that there's no data presented. I couldn't find it anywhere for 2008 to 2011. So we don't have a sense of what they exported if they were holding back at that point. But what we can see right now is that with the price action and the lease rates in London, and also you and I were just talking about the net UK exports of palladium that we've seen here in the last few months. That September they went from exporting, let's say on average, about 100,000 ounces a month prior to about a 20,000 ounce net import, and it was about a 20% jump in the price in September, and they've jumped another 20% since then. Right, it's been a 40% move.
Right.
So I think reading between the lines there, that we can see that there's very little physical left in London, which is, according to the former CEO of JENSEN, that was where all of the world's primary available Western palladium stockpiles had been moved from Switzerland between 2009 and 2013. So it looks to me like this market is dry, and it's very, very tight. And now we look to Russia for some consideration to save the paper positions of the banks, and I think that the stress will continue to increase because I just don't see how, given the geopolitical situation and the continual agitation of Russia by the West, from my standpoint here, how they could continue to step in to really help out the London bullion banks.
I've seen on your Twitter feed, you do a lot of tweets lately of palladium, just because of how interesting the story is at the moment. You were one of the tweets had the NYMEX warehouses of palladium stocks, which are very, very tiny in general history, and then even the ETF. You can see the palladium ETF. The amount of holdings physical that are in either have been dwindling precipitously, really, since 2014, 2015 to today. So yeah, it kind of falls in line with exactly what we're seeing, which is tightness in supply and increasing prices.
Yeah, the NYMEX is structured. The COMEX is not really structured as a physical market. If you read their articles, the directors of the COMEX are allowed to intervene and to force cash settlement if they deem it important. And what really for me is telling is looking at the registered stockpiles there. It's about the open interest. The total claims in the market is of the order of about 2.7 million ounces. Checked a couple days ago. And the registered stocks in all 10 of the NYMEX vaults is running about 18,000 ounces, right? So you've got hundreds of ounces of claims per ounce that's available there. So it's not a physical metal market the way London claims to be.
Right, right. I was looking as well, last time we had this discussion about palladium, it was in late September, and we both agreed the potential of price going up was obviously we thought the potential of going up was higher than it going down at the time, just given all the fundamentals we just mentioned. We had talked a little bit about the potentiality of platinum thrifting, and you had essentially said that it would be very, very difficult to do that so quickly. And I have a quote here from late October from Raul Mittal. He's a technical specialist of diesel aftertreatment at General Motors. He said at the LBMA meeting in Boston just a few months ago, he said it's not a flick of a switch for us. Anytime you want to make a substitution like that, it's at least 18 months to a 2-year cycle if we're going to switch. We have to be careful by the time we do all that, prices don't change or negate the benefits. So essentially it's a long process. If you do all of a sudden, we have a gap here between platinum and palladium. That's probably the widest we've seen in the fiat currency era. I'm not sure prior, but certainly in the fiat currency era, this ratio is about as tight as it's been maybe since 2000, 2001. So it's, it just basically speaks to the fact that, we could have a situation where the price of palladium goes lopsided to the upside here without any thrifting happening in the short term.
Yeah, I agree. And, there's two things at play here is that there's a lot of people that appear to have had the pairs trade on of long platinum and short palladium expecting the flip, right, to switch over and to stop the consumption of palladium. But I think what really kind of arched my eyebrows when I read it was that Goldman Sachs here about a week ago said their analyst, I think it was a week ago today, today's November 30, is that Goldman Sachs, their analyst said that that platinum is no substitute for palladium with the new high-performance catalytic converters, which meet the stringent 2020 environmental requirements. So I suspect what's happened in the last week here is that there's been a rush to cover. I mean, platinum, last time I looked, was about $800 an ounce or $803, something of that order.
Right.
And palladium was $1180, and they really spread apart markedly the last week. And so I think that there's a realization, and I did a little bit of research myself, and indeed there's numerous research papers that identify that palladium is the high performance material for these type of pollution control devices. And one other thing, James, I just did a quick check with one of the banks in Toronto today, and the lease rates of palladium have surged today up to 12.5% on the 1 month and to 12% on the 3 month versus in round numbers about 9.8% and 9.5% for the two respectively actually yesterday. So we're seeing a spiking here in the lease rate, indicating an acceleration of the shortage. And I think that we're going to see now where the market values palladium.
Yeah.
Up until now, we've seen where the bullion banks value it. And with the chokehold of London on the physical market, and then by taking away the NYMEX as a relief valve for the activities of London, we've really had a mispricing of these very essential assets and a complete distortion of the production profile globally of platinum and palladium. More than half of the African mines are on a cash basis losing money right now. Every day they operate, they lose money, and that's a consequence of the mispricing, and it's the unallocated, unbacked paper contracts in the world's dominant PGM or platinum group metals market in London at the LBMA, which is driving this distortion in the price. Yeah. And if you did not have the unallocated contract structure, you would not be able to swing prices and distort them for such a long period of time.
Yeah, I mean, that kind of goes back to the mantra that, eventually all manipulations, especially in commodities, they eventually fall apart because, low prices beget higher prices eventually because, if you have artificial low prices, that means people aren't making money from pulling it out of the ground. And eventually that means the supply will dwindle and therefore the price must go higher to meet the demand. Yeah. So this is great because the timing is excellent. It's really perfect because it coincides with the LBMA transparency push. And, they've been out there using their big megaphone talking about how transparent they're going to be with all their data, et cetera, et cetera. And, I try not to be such a cynic, but I mean, when you dive down their transparency data and you start looking at what they've been publishing, and I mean, there's just so many questions unanswered. And of course, you yourself have directly asked these questions to them, and I'm sure gotten no response. I believe GATA.org has also been doing the same. And, Ronan Manley over at Bullion Star has been a hawk on LBMA transparency push, and he's done really good work as far as describing, what a deceptive push this has really been in the sense that it's not really transparent at all. It's just a buzzword. I mean, you may have some thoughts on what they've been up to. I suppose I'd like to hear those.
Yeah, Ronan Manley has done just a fantastic job. He's very rigorous in the research he does. So I just want to give a hat tip to him right now for that. Mm-hmm. He's been an important contributor. So overall, the palladium market, as I mentioned, is a microcosm of those other markets. And the problem is that they continue to trade these unallocated contracts. And, in 2011, the LBMA came out with their local London liquidity survey and said, we trade 10 times turnover. Our turnover is 10 times the net settled value that we post on our website every day, meaning that the trade between the parties there is 10 times larger than people see when they see the net settled. Net settled is, if I owe you 10 and you owe me 9, we're just post one contract at the end of the day as the net trading.
Right.
And so what we find here is that there's 10 times the posted volume, and we have no idea what it is in platinum and palladium. Now, a week on November 20th, the LBMA came out and said, we're actually trading 1.5 times the net settled, right? So in 2011, it was 10 times. Now it's 1.5 times, and no further information. Trust us.
Yeah.
So, I'm just astounded. But I think that Palladium is going to give us some real insights into this market because of how small it is, and the hand waving doesn't work when you have this type of situation where it's a critical asset needed to keep auto plants open.
Yeah. And just a point on that, I mean, the U.S. government has strategic minerals and metals. They have a report that they publish every year, and the Platinum Metals Group is on that report, and it says basically that the Platinum Metals Group is essential to national security and our economy. So it's this is not like some non-important metal. This is absolutely critical for us to be able to drive automobiles and not pollute the world. So we're definitely at a very interesting moment when it comes to Platinum Metals Group, especially with palladium, the way it's breaking out in price. So it's going to be very, very interesting to see where it goes, and I look forward to hopefully seeing more exposure to real price discovery maybe in the months and years to come.
Yeah, I think we'll see it. And I thought that the Russia Today, that's the Russian state news agency, and they had an article they posted earlier this week, and it was to the effect that, is palladium worth more than gold, and why is Russia smiling? Mm-hmm. And, I took that as a troll, that they were trolling the LBMA because, they know they've got these guys this time, and that, we're going to see now I think a correction in the market and a reset of the price, and of course it'll overshoot to the upside, as long as it's not like a major economic crash where we lose 50-60% of our automobile demand. But the shortage is today, right? And economic crashes seldom happen overnight. I mean, it'd be the first time ever, but I guess it could happen. But I think we're going to see now what happens when paper meets metal demand. And metal beats paper every time. And I just don't know how the banks are going to wriggle out of this one this time. And I think it's interesting too that the new transparency push by the LBMA. I mean, they announced it November 20th. What their trading volume was, the ratio was between net settled and turnover, and they announced it like 3 weeks beforehand that they were going to release it, and they announced it at a conference in the U.S. and nothing was really posted on their website about it. So it looks to me like they're seeing the same problems that we're seeing, and there's kind of a rush to come clean here. So we'll see what happens.
Speaking of market rigging and practices trying to manipulate markets, I wanted to switch gears perhaps to kind of close out the interview and talk to you about what happened this past week with Jay Powell, the Federal Reserve Chairman. He was talking about the setting of interest rates and questions of whether or not they were going to continue to raise or perhaps they were going to pause. He talked about that the interest rates that they're setting their policy were just below neutral now, whereas only a month ago he claimed that they were still a long way from that point. And then, of course, the stock market saw that as dovish speak, and it popped up in a short-term bounce upward, giving the idea that perhaps they'll get some more support to help stock and equity prices. I just wonder, in the grand scope of things, what is your take on this? What are you thinking in terms of the Federal Reserve and what they're up to?
Yeah, I mean, the Federal Reserve, I think what has really done extreme damage to the U.S. economy, I mean, it's not just the last 40 years of declining interest rates down to 0%, while the price of gold has been shut down in London. And by the way, the London bullion market was created by the Bank of England. Creating the paper market and disconnecting the demand for metal from interest rates. We know that in 1980, real interest rates went to plus 9%, so 9% above the price of above the rate of inflation to bring investors back into bonds out of gold when they had run such loose monetary policy for the Vietnam War and other things. So what we see right now is that the damage has been done by reducing interest rates to 0%, and for such a long period, running it for 7-8 years. And what it does is it creates consumption which is not supported by the productivity of your economy. And secondly, what it does is builds in a dependency on low interest rates and essentially free money in the economy. And then to raise interest rates after a prolonged time like that is going to have a precipitous impact on the economy. And I think if we look at that true money supply -2, which is the broad measure, and that's something that's posted on Acting Man, but it's a very, very useful measure. What it measures is all cash that's available in the economy or in the banks that's checkable. So there's no time delay, there's no 30, 60-day hold on it. And that reflects the very liquid money supply. And we can see on that graph, I don't know if you can pull it up, James, but what we can see on it is that the last 2 times that they, as the economy's become more and more debt dependent over the last couple of decades, if they've reduced the year-over-year growth to the 5% or lower range, it's precipitated a crisis or a market bubble collapse. The dot-com bubble in 2001 was collapsed, and the housing bubble in 2008 and on was collapsed, and that came 12 to 18 months subsequent to tightening of that money supply. that makes sense when you've got a credit-dependent economy as they've created now, is that, with a debt-based monetary system, you choke off the availability of debt, and you're not going to be able to service the existing debt that's there and to fuel the unsupportable consumption which has come about as a consequence of the low interest rates.
Right.
So now they've done it again, as you can see there. We've 18 months, beginning of 2017, they started to precipitously lower interest rates again, and what we expect to see with the Austrian economic view of this is that there's been a choke off of the flow of credit into the market, and that these combined years of Bernanke and Yellen loose money is now going to come home to roost, and it's going to be a very, very uncomfortable period.
Yeah, I've been watching various videos, and we're looking at a situation where we have a huge amount of unfunded liabilities overhanging in the United States. I think Professor Kotlikoff, he estimates the net present value of those unfunded liabilities and debt that the U.S. has over $200 trillion. So over the long haul, I mean, the question is, okay, well, how are they going to default on that? Because they're not going to be able to pay that off with the GDP of 20 trillion roughly per year. So I guess the idea is you're going to probably have a combination of defaults versus dollar debasement long term. The other question, I suppose, was it's basically we're looking at a situation now where the Federal Reserve has roughly $3.8 trillion balance sheet, and you have a situation of unfunded liabilities staring at you in the face in the next 10, 20 years, as well as unfunded pension plans. There are a lot of pension plans that are underfunded. So you have a stock market that's potentially going to roll over. What is going to be the response to that? And, Raoul Pal, who is the founder of Real Vision, he believes that in the next crisis, the Federal Reserve will reverse course and essentially double their balance sheet up to $8 trillion, essentially doing what Japan did by going outright and just buying stocks and propping up the stock market. And, if anyone knows anything about Japan, there was a mega bubble there in the late 80s. And ever since they've been, propping up the stock market, et cetera. It's never reached the nominal highs that it was in the late 80s. And now the Japanese central bank, they own a huge swath of the ETF market and various stocks outright. So it gives the impression that, the Federal Reserve may do that, but that doesn't mean we're going to go into another bubble as far as equity prices and values. It may just simply be to kind of him the tide, I suppose, is basically what his point was. Well,
the Federal Reserve is founded upon a central deception, and the key element here to accept, in order to accept the idea of central banking, is that you can create real growth from printing money. And once you accept that, you can go through all kinds of papers and complex partial differential equations and all this stuff and come up with all kinds of crazy ideas. But if you distill it down, the central point there is that you can't create real growth from printing money. And so you've got to continually print money to maintain an appearance of growth. But as we know, we've got very, very high consumer goods inflation and all kinds of economic bubbles around us. So if the Fed responds with more printing, I'm not sure this is going to be a Japanese-style response. The U.S. dollar is the world reserve currency. And the fact is that the Japanese embarked on their multi-decade policy at a time where the rest of the world's economy was, although it became increasingly ill, it was relatively well or not nearly as distorted as it is now. Mm-hmm. So I just, we'll see what happens. They will try to print. There's no question. These are money printers. That's mm-hmm. what they do. As Bobber says, these are the money printers. And the money printing is the key to their deception, that they can create growth from nothing. And if you take it, the extension of that would be that if you can create growth from nothing by printing money, then why does anybody ever have to work? Right. Right? It's kind of like, well, let's just print money then. Let's just sit back and have a good time. Yeah. Right? So So there's going to be questions raised if they embark on further emergency monetary policy. There's still, in round numbers, about $3.5 trillion on the balance sheet of the Fed, and we're still experiencing emergency monetary policy because that balance sheet hasn't gone to zero yet.
Mm-hmm.
So they never got done with the first round, and now it works so well they're going to do it again.
Mm-hmm.
It'd be interesting to hear what the argument is for that, of why you want to embark on a failed policy again. So it may be that we just see the end of the Fed. I think more and more people, it's not you and I, James, there are rafts of people out there who are just asking the question that they've never asked before, that they're looking at this with a lens of view that's outside of what they were taught in university economics,
Mm-hmm.
Which is how in the world can you guys think that you can do this and maintain any kind of a semblance of growth and not destroy the market economy? And maybe that's the point. Maybe the market economy is really the target here. But I think there's going to be an uproar as people realize that this is one of the greatest deceptions.
Yeah, I think it was John Exeter once who said that this is in the broad scope of things, Federal Reserve is the greatest. That the financial markets are like a crime and punishment type of situation, and that the Federal Reserve essentially has been running the largest crime of all time, and therefore the punishment, the end result, the aggregate punishment will be the largest of all time as well. So
the Fed is a creator of economic bubbles, and for the banks, and then it stands in place as, they call it, the lender of last resort, but it's gambling insurance.
Mm-hmm.
And so the Fed stands there. They've got the back of the banks. The banks gamble, and they make, and it's the old, heads I keep the gains, and tails you bail me out, right? And so it's a never lose, and it also allows, it was put in place for World War I, and World War I occurred, and they had the deficit financing there because they could print. And then we had the 1920s bubble, and they chopped off the monetary supply, and it created the Depression, and they took gold out of the monetary system.
Mm-hmm.
But from my point of view here, it's a thoroughly corrupt institution, and it's founded on a key deception of that you can print money and create real growth, and that's not true. There must be another reason for it to be there, and the reason is that it allows massive deficit spending. And number two, it allows fun times for the financial institutions who are the shareholders of the regional banks in the Fed, and it provides gambling insurance for them. So
wow.
they've always got a positive, rosy outlook, no matter what the market